Good afternoon, everyone, and welcome to the forecast for 2017. This is being recorded on Friday, January 20th. Just a few hours ago, we swore in our 45th President of the United States. Today, we're going to talk a little bit about what happened in the global economy and the financial markets during 2016. We'll take a look at where we've been, where we are, and where we're going in the upcoming year. If you don't like surprises, 2016 was probably not the year for you. It was chock full of unexpected events, including Olympic incidents. Remember Brian Latke? The British vote to leave the European Union. A shocking number of movies and TV programs based on comic books. You know, it's incredible how much lack of creativity there must be in Hollywood. And obviously, the election of Donald Trump as President of the United States. The last surprise is the revelation that pollsters and pundits are, in fact, fallible. First, we got the Brexit wrong. Then they miscalculated the outcome for the U.S. elections. It's possible, after current failures, that pundits and pollsters would become more circumspect, like they are in Italy. In early December, Italy held a referendum to vote on some of the more controversial changes to its constitution. You may not know it, but the country has strict laws about polls. The government does not allow any polling data to be shared during the 15-day period before a vote. Needless to say, pollsters have found ways around this restriction. One site tracked results of a fictional Vatican conclave, where folks would vote yes or no. Another group tracked the horse race. The race was titled the Grand Prix of the Constitution race in Rome. Interesting, the race was designed so that the horse that took longer to run was winning. And the third pollster discussed an upcoming fictional vote on an automotive law. The polls may have been fake, but the pollsters got it right. They predicted a no vote. The referendum was rejected, and the Prime Minister resigned. I thought it would be a good idea to kind of warm up our brains before we delved into some more educational stuff by testing your pundit skills. Completely unscientific, of course, and just for fun. A pundit is an expert in a particular subject, right? Well, we're all consumers, so I thought we'd take a look at some advertisements and see if we can discern what the ads are really trying to sell us. Let's first take a look at the print ad, and as consumers, let's see if we can predict what the ad is actually promoting. Do you want a hint? A lot of drivers will love it. Okay, well listen, the answer is this. This is an ad for a car maker regarding new technology for a precision parking system. It steers the car right into tight parking spaces. Let's try another. Can you predict what this ad is promoting? All right, I'll give you a hint. It helps prevent toothaches. It's an ad for dental floss. Last one. This one I actually got. What do you suppose this ad is promoting? Do you want a hint? Think fast food and connectivity. This is an ad for Wi-Fi at a popular restaurant known for its golden arches. Pundits are supposed to anticipate what's next. When they don't, or when they're wrong, it can have a tremendous impact on financial markets. This actually appeared in The Economist in their World of 2017 edition. A lot of unexpected things happened in 2016. 3 led to significant market jolts. In the early part of the year, investors were startled by weaker than expected growth in both China and a surprise in currency devaluation. The second occurred in June with the Brexit surprise. The British vote to leave the European Union. The outcome amazed the world, and if news reports were accurate, it also surprised many people who voted for the British exit. And the third Well, that happened in November when, for the first time in 108 years, the Chicago Cubs won the World Series. You see that dip in the S&P? It wasn't because of the Cubs' win. It was pre-election jitters. Just a few days after the Cubs' victory, Donald Trump won the U.S. presidential election. As the U.S. vote tallies rolled in, Dow's futures, which are a measure of overnight sentiment, began to lose significant value. The losses were large enough to trigger market circuit breakers and trading stopped. During the pause, investors listened to Donald Trump's conciliatory acceptance speech and considered the policies the Trump administration might pursue. When markets reopened, U.S. stocks headed north. The Financial Times explained it this way: "It's been quite the turnaround. The overwhelming finance industry view before the election was that the stock market would tank if Donald Trump triumphed. But when confronted by the reality of his election win, stock investors swiftly switched back to a more natural state of optimism, focusing on the prospects of growth-boosting stimulus, tax cuts, and tax reform, and a rollback of industry-inhibiting regulation. Simultaneously, bad policies were dismissed as campaign rhetoric." Like beauty, good and bad policies are in the eyes of the beholder. In the United States, we saw considerable sector rotation. Industrials rallied. Technology companies sold off on trade worries. Utilities and U.S. Treasuries lost value as investors embraced the idea of an economy invigorated by tax cuts and higher government spending on infrastructure. Investors who liked more protectionist policies like tariffs on imports and limiting global trade helped fuel a rally in small cap stocks. Barron's wrote, "There is good reason for small cap outsized reaction. Although it hasn't been discussed much since the Trump victory, the president-elect won on a platform calling for more protectionism and less global trade. That would benefit smaller companies, which typically generate less than 20% of sales overseas, over the larger companies whose non-U.S. sales exceed 30%. While markets were quite optimistic at the end of 2016, the reality is no one can be sure how or when companies and share prices will be affected by policies that have yet to be implemented. Markets weren't pushed higher solely on faith in the possibility of new policies. Higher share prices also reflected improving corporate earnings. U.S. companies have been in an earnings recession for more than a year. Each quarter, companies reported earnings that let investors know how profitable they are. For 5 consecutive quarters, the earnings of companies in the S&P 500 have declined. During the third quarter of 2016, the recession ended and earnings for these companies increased 3.3% year over year, according to FactSet. As you can see, some sectors of the market did better than others. Investor enthusiasm for stocks pushed major U.S. indices to all-time highs late last year. The valuations of the S&P 500 index were trading at pretty heady levels. One way to assess market valuations is to look at the trailing price to earnings, or the trailing PE ratio. As you can see, the trailing PE ratio for the S&P 500 on December 29, 2016 was 20.6, while the 5-year average PE was 16.4 and the 10-year was 16.1. The fact that the S&P 500 index is highly valued doesn't mean there aren't opportunities to be found in the U.S. stock market. Specific niches may offer attractive investment opportunity. Not all world markets have risen to new heights during 2016, however. On December 14th, the Wall Street Journal published this chart showing the relative performance of developed markets around the globe. Emerging markets, which peaked in 2007, were having a fairly strong year until the U.S. presidential election. This chart will show not only the date upon which some of these markets achieve their all-time high, but more importantly, the percentage that some of these markets are actually down below their high. Here you can see the S&P 500 index, which is blue-green shaded area. The olive green line above represents the MSCI Emerging Market Index. Emerging markets were top performers going into the election and faulted after investors moved about $24 billion out of emerging markets. Barron's reported performance of emerging market countries is all over the map since the U.S. presidential election, signaling a bumpy ride ahead. The weakest markets, including larger ones such as Turkey and Mexico, have layers of problems. But there are countries where corporate earning strength is a reason for bullishness. The yellow line is the Stoxx Europe 600 index. Japan's Nikkei 225 is orange, and China's Shanghai index is brown. The gray line is the UK FTSE 100 index. Even indices that experienced a decline following the election have since moved higher. That move has an awful lot to do with the US dollar, which has strengthened since the election. You can see many emerging market currencies have lost value relative to the dollar. There are pros as well as cons to this strength of the US dollar. The Economist reported, these days, dollar strength tends to have a tightening effect on global financial conditions. The waxing and waning of the dollar is strongly linked to the ups and downs of the credit cycle. When the dollar is weak and American interest rates are low, companies outside America are keen to borrow dollars. But when the dollar goes up, the cycle goes into reverse as corporate borrowers outside the U.S. scramble to pay down their dollar debts. This causes a more general tightening of credit. In the United States, the Federal Reserve is tightening monetary policy. It raised the Fed's fund rate in December, and increases are expected in 2017. As monetary policies tighten, interest rates are expected to rise, which has some folks asking whether or not the bull market in bonds is near an end. As the chart shows, from about 1950 straight through to 1982, the United States experienced a bear market in bonds. Interest rates moved higher, which pushed bond prices lower. Since mid-1982, we've experienced a sustained bull market in bonds. Interest rates have fallen, which have helped to push bond prices higher. The recent rout in the bond market following the presidential election has left investors contemplating what a world of higher interest rates, more inflation, and perhaps even stronger growth could mean for financial markets. The assumption is that expansive fiscal policy and a less cautious Federal Reserve should mean even higher yields. During periods of rising interest rates, bonds tend not to perform well. However, historically, stocks have tended to do better during bond bear markets. Bond rates around the world have moved higher since the U.S. presidential election, but as you can see, higher is somewhat of a relative term. The Japanese 10-year government bonds are higher, but still yielding close to zero. The gap between the German and American 10-year yields are at their widest since the 1980s, and the British 10-year government bond yield is about the same today as it was during the Brexit vote, but it's certainly below January's levels. In a rising interest rate environment, bonds may have more risk than investors normally associate with this asset class. After accelerating a little in Q3, business surveys suggest that the world economy has continued growing at a fairly rapid pace in the final months of 2016, Labor market data for the U.S. has been encouraging. The Eurozone and Japan are doing better than many expected, and the UK has continued to weather the referendum fairly well. Let's take a look at where we are now. There's been a lot of talk about fake news versus real news. It's a problem we've had before. In fact, back in 1938, Orson Welles' radio drama, The War of the Worlds, caused panic among listeners. Slate.com reported that there was in fact no panic following the broadcast. It was in fact fake news. The newspaper industry sensationalized the panic to prove to advertisers and regulators alike that radio management was irresponsible and not to be trusted. Let's see how good you are at distinguishing fake news from real news. Let's take a look at these headlines and tell me whether you think it's true or false. The first, at West Point, annual pillow fight becomes weaponized. Well, guess what? That's a true headline. Some football positions linked to high blood pressure. Also a true statement. Apparently, it's prevalent with linemen. Queen offers to restore British rule over United States. When I read that, I knew that was fake, and it certainly is. More people have died from selfies than shark attacks this year. It's fake. I actually thought it was real. You see a lot of crazy people taking selfies. The North Pole is an insane 36 degrees warmer than normal as winters descend. You know what? That's true. And somewhat scary. And the last one, Cleveland Indians rattled by deafening sound of Wrigley Field's crowd's indigestion. Well, it comes from the Onion, so the likelihood is it's fake. Sometimes it's hard to distinguish true from fake news. In The Economist, in that same worldview of 2017, they stated that the world economy is actually in much better shape now than it was just a decade ago. But we're just not growing fast enough, or fast as we did. This chart from The Economist shows world gross domestic product, GDP growth, the change in the value of goods and services produced over time. You can see the dramatic dip in 2008 following the financial crisis. During the third quarter of 2016, the world economy grew by 2.7% year over year, down from 2.8% the previous quarter. Norway was the only advanced economy whose economy actually contracted, and the United States economy expanded faster than it did in the second quarter. India and China accounted for 65% of world growth. Other emerging markets contributed 16%, down from 21% in the previous quarter, their lowest share since 2008. When you drill down and look at specifics, some countries are doing better than others. This chart shows GDP growth, unemployment, and inflation estimates for 2017 by country. India shows the strongest GDP growth, while Brazil is expected to see GDP declines. Emerging Asia, which by the way is a subset of the emerging markets, includes countries such as China, India, Indonesia, Malaysia, the Philippines, Thailand, and Vietnam. They're growing rapidly. In 2017, the region is expected to produce twice as much as the European Union. This, according to The Economist. One part of emerging Asia is facing some significant issues that could constrain its growth eventually. China has a mountain of debt. The Economist explained, China's total debt has soared to more than 250% of their GDP, nearly doubling over the last decade. Increases of that scale usually precede a major slowdown, if not a crisis. For the time being, China will keep a lid on these problems. The president is gearing up for an autumn Congress in which he will consolidate his power, so officials high and low know their overriding task is to preserve economic stability. Now, just to put that in perspective, as much debt as we have, our debt is nearly equal to our GDP. To have 2.5 times that is really problematic. While China has debt issues, Europe has a refugee issue. A 2016 report from the International Monetary Fund says in the short term, the macroeconomic effect from the refugee surge is likely to be a modest increase in GDP growth, reflecting the fiscal expansion associated with support to the asylum seekers, as well as the expansion of labor supply as newcomers begin to enter the workforce. The effect is concentrated in the main destination countries, those being Austria, Germany, and Sweden. In addition to refugees, the European Union has yet to see how the Brexit will play out. It may take years for the full effects of the Brexit vote to be realized, the Economist explained. The referendum was supposed to resolve Britain's relationship with Europe once and for all, yet in laying the in-out debate to rest, it sparked many more questions. Should Britain seek to stay in the EU's single market or its customs union? How much should it pay into EU's budget for the privilege? Should it maintain the free movement of people? What sort of border should it have with Ireland? Countless more puzzles await on everything from patent protection to space exploration. Since 2014, when the European Central Bank first set its lending rates in negative territory, the volume of negative yielding bonds swelled across Europe. This chart shows countries offering government bonds with negative yields in 2015. By August 2016, 13.4 trillion of negative yielding bonds were available across Europe and in Japan. There is a change underway, however, Financial Times explains. The global stock of negative yielding debt has tumbled more than 2.5 trillion since the summer, underscoring the dramatic sell-off in bond prices and easing the burden on pension plans that have been starved for income by low rates. Yields have risen across the board, led by the U.S., as investors anticipate substantial fiscal stimulus next year under President-elect, or now I should say President Donald Trump. The Trump bump helped push interest rates higher. It also changed inflation expectations. Investors rapidly embraced the idea of a Republican-controlled Congress being a game changer by implementing fiscal stimulus, tax cuts, and rolling back on regulations for U.S. business. Soon the concept of Trumpflation took hold, whereby fiscal policy would supercharge the economy and nurture inflation. The potential impact of strong fiscal stimulus may be the reason the Federal Reserve has become more hawkish. In December, the Fed raised the funds rate for the second time in the last decade, and policy-setting members' assessments of what would be appropriate going forward show that there might be as many as 3 rate hikes in 2017, as rates move from 0.25 to 0.5% to a range of 1.25 to 1.5%. So, where do we go from here? There are high-tech trends, the Internet of Things, artificial intelligence, self-driving cars, smart houses, drone delivery, the augmented reality games that seem to be pushing us toward the age of the Jetsons. There are also low-tech trends, slow food, slow travel, sustainability, the sharing economy, seeking experiences rather than collecting stuff. This has pushed culture in a different direction. Diverse trends appeal to diverse groups of people, and companies around the world are continuously finding new ways to meet consumer demand. As long as they exist, there will be abundant opportunities for investors. Those opportunities may be found anywhere in the world, although economic growth is expected to be more robust in emerging countries than in advanced economies in the upcoming year. Some specialists believe global economic growth will gain momentum in 2017. Morgan Stanley posits the global economy, listless the last few years, looks ready to rise, stretch, and get a move on again. The new momentum could push global economic growth to 3.4% in 2017, compared with an estimate of about 3% annualized growth for 2016. The Conference Board, on the other hand, expects another slow growth year. The more things change, the more they stay the same. That's the message of our economic growth outlook for 2017 and beyond. In our sixth year of global stagnation, we see little chance of dramatic change, but some potential good news. Stabilizing energy and commodity prices could create a tailwind, at least for resource-rich countries, and digital may increase productivity. As mentioned earlier, there are a lot of questions about which policies the U.S. will adopt. In a recent poll by Oxford Economics, 27% of participants thought a potential trade war triggered by Trump was the top risk to the global economy over the next 2 years. Trump also was seen as the most likely source for faster economic growth, with 38% citing the potential for the U.S. economy to surge on new fiscal stimulus that he's proposed. Even in the midst of uncertainty, before any policies have been clearly defined, analysts have been willing to make some predictions about the year ahead. FactSet has collected analyst earnings projections. This chart shows the estimated earnings growth in various sectors of the S&P 500 index for 2016 and 17. There are noticeable differences. Real estate, which did well last year, may not do so well this year. Financials that were absent last year should do well. And there's a complete change in fate with respect to energy. Rolling off of bad earnings last year, seeing improved earnings this coming year. Every December, Barron's surveys a group of prominent strategists from investment banks and money management firms about their outlook for stocks, bonds, and the economy in the year ahead. Some were more optimistic than others. Overall, there was a shared belief that U.S. companies would benefit from anticipated lower corporate taxes, infrastructure spending, and reduced regulations. Among the small and less optimistic group of financial professionals was John Vilas, Vice President of Global Macro Strategies for State Street Global Markets, who believes caution is warranted. John said, markets are betting big on the best possible developments in fundamentals. Furthermore, there is an argument that the long-run potential of the U.S. and other major economies is structurally and historically low, capping any upside to growth from policy. It's not positive for risky assets to have an economy generating rising inflation while also being constrained by low or mediocre growth. Also skeptical was Randy Frederick, Vice President of Trading and Derivatives at Charles Schwab. In late December, he told Business Insider, "The only thing I'm worried about is that it seems that nobody is worried about anything right now. Really, nobody was hedging the downside in this market. It's pretty unusual." Barron's also asked various strategists about the outlook for bonds. Many believed interest rates may remain volatile during 2017. There are long-term shifts that are just starting to take hold, with plenty of uncertainty about how they'll all play out. Just because rates have surged recently and bond prices, which move inversely to rates, have fallen, doesn't mean that the trend will continue throughout 2017. Consumer sentiment was also important in 2017. The University of Michigan's Index of Consumer Sentiment rose to 98 in December of 2016, reflecting a surge in consumer confidence. It was the highest reading since January 2015 and was closing in on the highest level since 2004. Surveys of Consumers' chief economist, Richard Curtin, wrote, "The most important implication of the increase in optimism is that it has raised expectations for the performance of the economy. Either too low growth or too high expectations represent barriers to maintaining high levels of consumer confidence. Until specific policies are proposed, there is no reason to alter 2017's forecast of 2.5% for real consumption." You know, whenever markets become extremely optimistic, I contemplate the words of Sir John Templeton, a contrarian investor who once said, "All markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell." I don't know where we are right now, but it certainly doesn't feel like euphoria. No matter what your point of view is, we are here to help pursue your financial goals. We spent a lot of time discussing the outlook for world economies and financial markets, which will influence our investment strategies for 2017. Just as important, however, it is for us to know how your lives may be changing in the upcoming year. Maybe there's a marriage or a new grandchild on the way. Maybe an illness is creating unexpected financial issues. Life changes play an important role in determining the financial strategies that will be right for you. So please, let us know what changes you expect in 2017. So with that in mind, I'd like to wish each and every one of you a very happy, healthy, and prosperous new year. And if there's anything we can do to make 2017 an even better year, please let us know.